Today we are researching in detail a case study that, and I'm not exaggerating, really belongs in the Hall of Fame of market timing.
Oh, absolutely. We're talking about high-conviction C-suite execution at its absolute finest.
It's this incredible ability of corporate insiders to see a full-blown market panic for what it really was, a generational buying opportunity.
It really is the kind of trait you look back on and you just realize that information asymmetry isn't just a theory, right? It's a measurable, deployable advantage.
And today we are focusing entirely on Eli Lilly. Ticker, of course, is LLY.
And this spectacular, almost unbelievable event that unfolded back in August of 2025.
Spectacular is almost an understatement. I mean, think about this. In the space of about 10 days, Eli Lilly, one of the most dominant pharma players on the planet,
Right.
just manages to shed $100 billion in market value.
Gone. $100 billion. The collective market just decided the world was ending for their pipeline, and the stock crashed, what, 20, 25%?
And that collapse was perfectly bottom-ticked by the people who know the company best.
Which is why we're getting into the weeds on the mechanics of this LLY trading cluster. It was like a coordinated strike by 8 insiders who saw the market's hysteria as nothing more than a temporary discount window.
And look, this wasn't some minor token purchase to signal confidence. This cluster saw the CEO,
The CEO?
the CFO, and the chief scientific officer, along with multiple key board members, deploy over $3.4 million.
Of their personal capital.
Yes, their own money, into open market buys right as the stock was hitting the floor.
The outcome is almost comical in its precision. I mean, we're looking at returns from 50% to 63% in just 97 days.
97 days. That just drastically outpaces anything else in the market.
And that isn't luck. It's not a coincidence. That is pure conviction backed by superior information about where the company was really going.
So our mission today is to break down exactly how this happens. How do you lose $100 billion 1 week? Only for the company to become the first pharmaceutical player to hit a $1 trillion valuation just 3 months later. That movement right there, that defines the power of the insider signal.
Okay, let's unpack it.
We have to start with the panic.
Yeah, to really understand why those, $640 stock prices were such a screaming buy, you have to appreciate the depth of the market's fear.
Right.
Lilly was positioned right in the center of the GLP-1, the weight loss and diabetes tsunami.
And when you're the market leader, any little perceived flaw just gets magnified exponentially.
Exactly. Lilly got hit by what we call a perfect storm. It was this 2-stage technical and fundamental setup that created a completely distressed price environment.
And the market was already on edge. We saw the first blow, what we're calling the sympathy pain, arrive back in late July 29th to be specific.
And this wasn't even Lilly's fault.
No, it was pure contagion.
Absolutely. Their main rival in the GLP-1 space, Novo Nordisk, they announced this dramatic cut to their 2025 financial guidance. They were the first to blink.
Citing what? Slower than expected GLP-1 uptake?
Slower uptake, specifically in their obesity drug segment. They cut their expected sales growth from a very healthy 13 to 21% range. Down to just 8 to 14%. That's a huge cut.
And the market response was just brutal. Novo Nordisk cratered, was it 22%?
Worst single-day drop in its history. And naturally, that fear immediately bled over into Eli Lilly.
The thinking was simple, right? If the whole market is slowing down, Lilly must be slowing down too.
Of course. Lilly immediately fell 4 to 6% in sympathy. It dropped from the 760s range to around 720, 730.
And this initial dip was based on nothing tangible for Lilly. It was entirely perception and fear.
The fear that Mounjaro and Zepbound would face the same supposed slowdown, even though, Lilly had consistently shown a much better supply chain and better commercial positioning.
But that sympathy pain, that was just the appetizer.
The knockout punch.
The knockout punch arrived about a week later, on August 7th, when Lilly released its own Q2 2025 earnings report.
And here's the fascinating contradiction. Objectively, the earnings crushed expectations. They were excellent.
Stunning, really. Revenue hit $15.56 billion, beating estimates by $850 million.
And EPS, $6.31. That's a beat of 74 cents.
We saw Mounjaro sales at $5.2 billion, Zepbound at $3.38 billion, both way ahead of what Wall Street was expecting.
And they raised their full-year revenue guidance.
They did, raised it up to $60 to $62 billion.
And let's not forget this part. Their core business, the actual revenue engine of the company, was accelerating at a stunning 38% year over year.
With 85% gross margins. I mean, any sane financial observer would call that a blowout quarter for any company, let alone a large-cap pharma.
Any sane observer, yes. Yet, the stock absolutely collapsed. The market just didn't care about the 38% growth or the beaten raise.
No, it fixated on one single, disappointing pipeline detail, almost buried in the release.
The phase 3 trial data for orforglipron, their oral weight loss pill.
And this is where the technical nuance meets the emotional trading reality. Wall Street had, in its infinite wisdom, convinced itself that for this oral pill to be competitive with the injectables, Mounjaro, Zepbound, Ozempic, it needed to show 15% weight loss.
It was a totally arbitrary number, but it became this firm consensus target.
And the trial results missed that arbitrary target. The data showed 12.4% weight loss.
Which is about 27 pounds on average. Now, let's be clear. 27 pounds of sustained weight loss from a simple once-a-day pill is profoundly clinically meaningful.
But it missed the magic number by 2.6 percentage points.
So the market now has a narrative problem. And it wasn't just the miss on the number.
No, it was combined with this concern about tolerability. The drug showed a 10.3% discontinuation rate due to side effects, mostly GI issues.
Versus just 2.6% for the placebo group.
So that combination, missing the 15% target and the headline worries about tolerability, it triggered absolute hysteria.
Complete hysteria. The market completely discarded the accelerating core business, the massive revenue beat, the 85% margins.
It was a classic case of myopia, ignoring the fundamental forest.
Which is trillions in potential GLP-1 revenue.
For one single disappointing tree. A 2.6% miss on one pipeline drug.
And the reaction was just brutal. Shocking, really, given the underlying strength.
Despite that excellent earnings report, the stock plunged 14 to 18% in a single day. It dropped to an intraday low of $6.39.
And by the next day, August 8th, Lilly touched its 52-week low of $623.78.
That's a 20 to 25% crash in just 10 days. Your estimated $100 billion in market cap just evaporated.
This isn't noise. This is capitulation.
And, of course, the analysts poured gasoline on the fire. Leering Partners immediately downgraded LLY.
And they slashed their 2030 sales forecast for orforglipron from $22 billion all the way down to $14 billion.
They just cemented the negative narrative. This oral drug wasn't the blockbuster everyone hoped for, so the entire valuation was toast.
And this divergence, that's the setup. The PE ratio, which had been up above 60, reflecting all those high growth expectations, it just collapsed into the mid-30s, low 40s range in days.
So you have a company delivering 38% revenue growth, crushing EPS, raising guidance.
But it's trading at a multiple you'd expect for like a mature, slow growth utility company.
This was the moment.
This was the moment. The insiders, armed with better information, they recognized this massive temporary discount.
So the stage is set. The stock is technically destroyed, but fundamentally sound. This brings us to Section 2, the coordinated strike. And if you're tracking insider activity, you know that a single executive buying a few thousand shares is, interesting. But seeing the entire leadership apparatus move in sync.
That is the signal of a lifetime. It truly is. At a huge company like Lilly, seeing the C-suite and multiple independent directors all cluster their trades within a 7-day window.
Right after an unexpected crash.
It's the highest magnitude signal possible. It eliminates any possibility of this being routine. This was a synchronized, high-conviction deployment of capital.
Let's break down the timeline, starting right at that moment of peak fear. The stock hits its 52-week low on August 8th. Who was the first to step into that knife fight?
That would be Director Jameer Jackson. He's a key figure here. He chairs Lilly's audit committee, and he's the CFO of AutoZone. So his financial acumen and risk assessment are clearly top tier.
And he buys on August 8th.
On August 8th, he purchased 200 shares at $639.56, deploying about $128,000. He initiated the cluster, essentially bottom-ticking the immediate market panic.
But the real conviction, that became unmistakable 4 days later, August 12th. This was the anchor day.
The anchor day. 5 insiders struck simultaneously.
And leading the charge was
CEO David Ricks, the ultimate signal. Ricks made the largest single purchase, 1,632 shares at $644.77.
For a total of just over $1.05 million.
Yeah, and think about the messaging there. A sitting CEO of a major pharmaceutical company is deploying 7 figures of his own cash.
Not stock options.
No, his own cash into the open market with no schedule, days after a devastating crash. That tells you he is putting a gigantic personal stamp on the conviction that the stock is completely mispriced.
Exactly. And the placement of the buyers is so crucial. Right alongside Rick's was who?
Chief Scientific Officer Daniel Skavronsky.
The scientific leader. So if the crash was triggered by scientific uncertainty over the orforglipron data,
Then the scientific leader of the company buying heavily is the perfect countersignal.
so what does Skavronsky buy?
He bought 1,000 shares at $634.40 for $634,000.
Okay, what's fascinating is that Skavronsky's purchase price was the lowest in the entire cluster.
Right. The executive most qualified to assess the clinical risk that triggered the whole collapse was the most precise in bottom-ticking the stock.
That suggests the scientific team was completely unfazed by the 12.4% result.
Not at all. And it wasn't just internal management. Independent directors stepped up, showing board confidence.
Director J. Eric Philwald, he's the CEO of IFF.
He also joined the $1 Million Club that day. He purchased 1,565 shares for over $1 million at $642.
You see that tight range, right? 634 to 644. They were all fishing in the exact same panicked waters.
Director Gabriel Sulzberger also added shares that day. This level of coordination removes all doubt. This is a shared, high-priority belief that the stock was being gifted to them.
And the action continued over the next few days, reinforcing the thesis even as the stock started its initial rebound.
Yeah, on August 13th, Director Ralph Alvarez bought over $500,000 worth at $660.
And Executive Vice President Jacob Van Naarden purchased over $647,000 at $647.
And the cluster concluded on August 15th with CFO Lucas Montars. He purchased 715 shares at $691.79, deploying nearly $500,000.
And this is a critical point. Montars bought after an 8% rally from the low.
Yes.
So why is Montars buying at 691 so significant if the low was, down at 634?
Because it demonstrates sustained conviction. It's not just tactical bottom fishing. By the 15th, the worst of the news was digested. The stock was already trending up.
Right.
And Montars, as the financial steward, was signaling that even after that bounce at 691, the stock was still deeply undervalued relative to the cash flows and growth they were projecting internally.
So his buy confirms the thesis wasn't just about catching a falling knife.
No, it was about valuing the company correctly for the long term.
Which brings us to the crucial technical factor here, the opportunistic timing. This wasn't standard operating procedure. These were not the routine, pre-scheduled trades we see all the time.
Exactly. And this is where we need to get into the weeds on SEC filing mechanics, especially for you if you're tracking these signals.
Okay.
These were open market, opportunistic purchases right after an unexpected crash. The key is the absence of the 10b5-1 checkbox on the Form 4 filings.
Okay, so for anyone who might be catching up, what does that 10b5-1 checkbox signify, and why is its absence so powerful here?
So a 10b5-1 plan is a trading plan that executives set up months in advance. We're talking 90 to 120 days before execution. They set the price and volume parameters when they don't have any material non-public information.
And that allows them to trade safely later, even if they do get confidential information. It insulates them from accusations of illegal insider trading.
Exactly. If that box is checked, it means the trade was routine, pre-scheduled, based on old information. It's not a strong signal.
But the absence of that checkbox here, what does that mean in terms of risk and timing?
It means the trades were opportunistic. They were executed just days after the negative catalyst, that August 7th earnings report shook the market.
And they couldn't have set up a new plan.
Legally impossible. They couldn't set up a 10b5-1 plan on August 8th and trade on August 12th because of that mandatory 90 to 120-day cooling-off period required by the SEC.
So they were making a high-conviction decision based on their immediate, real-time assessment of the company's health.
Absolutely knowing that the market was fundamentally wrong about the valuation. They had to be convinced that the internal reality would quickly overwhelm the temporary technical panic.
And they took on significant personal risk by deploying $3.4 million immediately.
That signal, the lack of the 10b5-1, the coordination of the C-suite, the CEO, CFO, CSO, and the sheer size of the purchases, that defines the gold standard for reading the insider signal.
So let's peel back the layers. If the market was panicking because of a 2.6% efficacy miss on an oral drug and ignoring a 38% growth rate, what specific internal knowledge validated their decision to deploy millions? This is where we research in detail the informational advantages.
Okay, we can isolate 4 major informational advantages that gave these executives the confidence to step in while the stock was collapsing. The first one directly addresses the catalyst that caused the crash.
Which was the true clinical viability of orforglipron.
Exactly. And remember, Skowronski, the scientific lead, was the lowest buyer. This suggests that the clinical data was perfectly fine from their perspective.
So why did management see the 12.4% weight loss result as a win when Wall Street called it a failure?
Because they understood the commercial landscape better than the analysts. The market focused narrowly on that 15% consensus number, but management focused on the patient need.
On the real world?
Yes. Achieving 27 pounds of weight loss from a simple once-daily pill, a pill you can take without refrigeration or complex injection schedules, that is a massive differentiating factor.
It addresses that enormous segment of the population that is just needle-averse or finds injectable regimens too complex. It completely changes the compliance equation.
Exactly. Management knew that an oral once-daily product that delivers close to 13% weight loss opens up a new, massive segment of the market, billions of dollars in revenue, that the injectables just cannot reach because of patient preference.
So the drug wasn't priced for failure.
No, it was tries to capture a niche that eventually becomes the mainstream. Skowronski was signaling that the 12.4% result was still profoundly commercially viable.
Okay, let's move to advantage 2, the core franchise strength. This is the data the market willfully ignored in that Q2 report. What specific commercial dynamics were the insiders tracking in real time?
They had real-time visibility into prescription data that was way more granular than anything public analysts had access to. They knew that Mounjaro had already become the #1 prescribed GLP-1 drug in the U.S. in July 2025.
They saw Lilly capturing 57% of the entire incretin market and gaining almost 4 percentage points of share over Q1 alone.
So while the market was focused on a potential slowdown based on Novo Nordisk's confession,
Lilly insiders knew they were actively accelerating their market share capture. That's a huge contradiction.
it is. And furthermore, they had insight into their direct distribution channel, Lilly Direct.
Right. Analysts were worried about large payer exclusions, particularly from CVS Caremark, which took effect in July.
But the insiders knew their pivot was working. They were seeing the direct-to-consumer channel successfully growing cash-pay Zepbound prescriptions from 4% up to 10% just since January. They were confident they could circumvent the traditional payers.
Advantage 3 is arguably the most fundamental argument for the long-term trillion-dollar valuation, the manufacturing moat. As people who worked in M&A, we know that in pharma, capacity often dictates market share more than efficacy, especially in a supply-constrained environment.
Absolutely. This is the deep structural information the market had completely underestimated. Insiders knew about the absolutely massive, almost unprecedented commitment to infrastructure. Since 2020, Lilly had committed over $50 billion
Billion.
in U.S. manufacturing investments across Texas, Virginia, Puerto Rico, specifically for high-volume production of incretins.
How did that give them an information advantage over the market back in August?
Because the market was used to seeing supply constraints cripple this sector, Novo Nordisk has been chronically plagued by its inability to meet demand. Lilly's insiders knew that their proactive capacity investment was coming online rapidly. They had already increased production capacity 1.6 times year over year for incretin doses.
And management had visibility into the ramp-up schedules. They knew they could scale production not just for Mounjaro and Zepbound, but also for a potential blockbuster oral like orforglipron.
Without the debilitating constraints that were plaguing the competition.
That confidence in supply security justifies the entire premium valuation. The ability to meet demand means every new prescription translates directly to revenue.
It guarantees market dominance. The ability to guarantee supply in a booming demand environment is worth hundreds of dollars on the stock price. The insiders knew they had built a fortress while the market was pricing them like a small biotech struggling with phase 3 results.
And finally, advantage 4. Imminent competitive shift. They knew specific hard data was about to drop that would end the debate over orforglipron's viability.
They had internal private confidence that the upcoming head-to-head trial data comparing orforglipron versus Novo's oral semaglutide.
Which was due out on September 17th.
Yes. They knew it would definitively show superiority. Skowronski and his team were scientifically certain of their drug's profile, even if analysts were distracted by that arbitrary 15% target.
And they recognized that Novo was faltering, cutting guidance, a CEO change, terminating programs.
While Lilly was executing flawlessly and gaining share, they were buying a company positioned to seize market dominance at a valuation that implied the exact opposite. They were buying the gap between the internal operating reality and the external market perception. And the beauty of this case study is just how quickly the external data came in and validated the insider's thesis.
So fast.
They bought in the first half of August, and by mid-November, the entire narrative had just completely flipped.
The first major piece of confirmation arrived exactly 1 month after the core buying cluster, September 17th.
This was the scientific validation, the release of the Achieve-3 head-to-head trial results that the insiders had private confidence in.
And those results were a knockout blow to the bear thesis.
A total knockout. Orforglipron decisively beat Novo Nordisk's oral semaglutide on every single major endpoint. The analysts who had panicked over 12.4% weight loss were suddenly confronted with data showing 73% greater weight loss overall compared to the competitor.
Let's put some specific numbers on that. Patients on orforglipron were achieving up to, 19.7 pounds of weight loss?
Versus only 11 pounds for the competitor's oral drug. And for the diabetes indication, the A1C reduction was vastly superior, negative 2.2% for orforglipron versus just negative 1.4% for oral semaglutide.
This data immediately forced analyst sentiment to reverse. The drug that had caused a $100 billion collapse was now scientifically cemented as the superior product in the oral segment.
It completely validated CSO Skowronski's conviction.
But the real acceleration came on October 30th with the Q3 2025 earnings.
This report confirmed that the core business wasn't just healthy, it was reaching escape velocity, exactly as the insiders knew it would.
The figures were just staggering. Total revenue hit $17.6 billion. That's up 54% year over year.
It beat expectations by $1.5 billion. And non-GAAP EPS was $7.02, crushing estimates by 19%.
This wasn't normal growth. This was growth acceleration, proving their capacity investments were already translating into sales volume.
And the combined tirzepatide franchise, Mounjaro and Zepbound, showed incredible strength. Mounjaro sales surged 109% to $6.5 billion.
And Zepbound jumped 185% to $3.6 billion. The franchise officially became the world's best-selling drug, surpassing Merck's long-standing champion, Keytruda.
And critically, management raised full-year revenue guidance again, up to $63 to $63.5 billion. They were confirming under oath that the momentum was accelerating, not slowing down like the market feared in August.
The stock just surged in response, continuing that aggressive recovery.
And then the final massive strategic catalyst arrived in November. The policy win on November 16th was crucial for solidifying the long-term multi-trillion-dollar thesis.
Yeah, this is where the M&A background really comes into play. Eli Lilly and Novo Nordisk reached a landmark pricing agreement with the Trump administration
to provide GLP-1 drugs to Medicare and Medicaid beneficiaries starting in April 2026. This is a game changer for volume security.
Walk us through the trade-off here. Why secure this deal at a potentially slightly lower monthly price, $245 a month for Medicare, when demand is already so high?
Because it removes a massive regulatory overhang and guarantees volume for the next decade. Analysts immediately saw that this secured a foundational patient base of up to 7 million Medicare beneficiaries.
So even if the price is a little discounted compared to the cash price.
Securing government volume removes uncertainty, it guarantees market presence, and it establishes a massive floor for the franchise's long-term cash flow projections. This policy security is fundamental to justifying a sustained high PE ratio.
And the market responded accordingly. Just 5 days later, November 21st, 2025, Eli Lilly became the first healthcare company in history to reach a $1 trillion market cap.
Trading around $10.49.60.
The stock had recovered completely from the August panic and achieved this historic valuation milestone, fully validating every single insider who bought in the 640s.
Let's just appreciate the sheer magnitude of the returns generated by the insiders who bought during that crash. They bought between 634 and 691.
And the stock hit 1050 a few months later.
CEO David Ricks, buying at 644.77, saw his $1 million investment gain 61.7% in 3 months.
So that's a profit of about $648,000, just by acting on internal knowledge that the market was fundamentally wrong.
And CSO Daniel Stavronsky, buying at the absolute cluster low of 634.40, he saw the highest percentage return, 64.5%, netted him over $410,000 in profit.
That is significant alpha generation.
Even CFO Lucas Montars, who we noted bought at the cluster's highest price, $691.79, after the initial bounce.
Still generated an impressive 50.8% return. That's capturing half a year's worth of market growth in 3 months.
The average return across the entire $3.4 million in coordinated insider buys was 57.3% in just 97 days.
Extraordinary.
I mean, the S&P 500 gained, what, maybe 4 or 5% in the same period? This level of alpha just confirms that the panic sell-off was entirely irrational relative to the company's fundamental trajectory.
The insiders recognized the dislocation, acted decisively, and captured nearly the entire recovery. So this LLY cluster, it isn't just a fascinating story, it's a masterclass in reading the signals that matter.
It really is.
And for those of you tracking this data, we need to distill this into actionable takeaways. If you want to spot this pattern in the future, we have 6 non-negotiable rules based on this exact trade.
Okay, rule number 1. Personnel, coordination, and timing. Always look for coordinated C-suite buying, especially during a sharp, unexpected sell-off.
Right. A purchase by a single low-level director might be interesting noise, but 5 directors plus the CEO, CFO, and the scientific lead buying simultaneously right after a crisis.
That is the highest magnitude signal.
And crucially, look at the role relative to the crisis. If the crisis is scientific, the CSO's buy is the strongest endorsement.
If the crisis is financial, a valuation collapse, the CFO or audit chair's buy holds maximum weight.
And here we had both. Skavronsky buying the scientific low, and Jackson, the audit chair, initiating the whole sequence.
Okay, rule number 2. Target the panic low. The insiders bought within 1 to 5 days after an unexpected dramatic crash. This is crucial.
This is not buying during a slow, gradual decline that might signal a value trap.
No. They bought precisely when retail investors and analysts were capitulating, and the stock chart looked technically catastrophic. This shows they were buying market emotion, not just market price.
Rule number 3. Check the SEC filings. Focus specifically on the 10b5-1 status. We can't stress this enough. The absence of that checkbox on the Form 4s is the differentiator between a routine transaction and an opportunistic strike.
The lack of the 10b5-1 plan confirms the trade was opportunistic, based on a current, immediate assessment following the unexpected news.
It tells you the executive team was in an emergency meeting, looked at the price, and decided to immediately deploy personal capital because they believed the discount was fleeting and unwarranted.
It shows conviction, genuine belief, and a willingness to expose themselves to regulatory scrutiny, a level of conviction that is far superior to a pre-scheduled trade.
Okay, rule number 4. Sizing matters. Look for significant dollar amounts that represent genuine conviction and personal risk.
Ricks's $1 million plus purchase is the signal. This is what differentiates the trade from those small token purchases meant for PR purposes. You need to see executives deploying serious portions of their liquid net worth.
Rule number 5. Post-purchase behavior. This confirms the long-term thesis.
Exactly. These executives did not immediately sell their shares at $900 or $1,000. Their sustained holding pattern confirms they saw the August price as a massive fundamental undervaluation.
Not just a tactical bounce play. They were betting on the trillion-dollar valuation thesis, which is tied to their manufacturing mode and policy security.
And rule number 6, look for the divergence. The absolute optimal setup, which Lilly provided, occurs when insider buying follows an earnings beat.
They reported 38% growth, raised guidance, 85% margins.
That paradoxically triggers a massive sell-off due to concerns about pipeline data or unrelated competition. The management is betting that the core business trajectory will overwhelm the short-term noise,
Correcting the market's forest for the trees error.
This LLY scenario checks every single one of those 6 boxes. It is the perfect instruction manual for identifying actionable insider signals.
So let's just briefly summarize this spectacular timeline one last time. Market panic over missing or forglipron expectations. $100 billion collapse. 8 key executives execute a coordinated $3.4 million buy at the absolute low, centered in the 640s.
And that thesis is validated by superior head-to-head data, a Q3 blowout earnings report demonstrating capacity success, and then the ultimate validation.
Achieving a $1 trillion market cap, trading at 1050 plus.
The verdict here is absolute. These insiders didn't have a crystal ball, but they possessed internal information on their supply capacity, on their market share capture rates, and on the true commercial viability of their pipeline.
That allowed them to assess the August sell-off as an irrational, temporary overreaction.
And when market sentiment is at its most negative, that is exactly when the most powerful, high-conviction insider signals emerge.
They bought when analysts were cutting targets by 35%. They bought when the chart looked toxic.
And they were demonstrably correct, generating north of 50% returns in 97 days.
This is why we track these signals.
And here's the provocative final thought for you to consider, tying this back to the core strategic advantages the insiders held. The $1 trillion valuation of Lilly was predicated on two specific things.
Yes.
Securing unprecedented manufacturing supply capacity, that $50 billion investment, and securing policy security with the Trump administration's Medicare deal.
And the conviction level across the leadership team remains incredibly high. We've seen this recent influx of new executives announced: Carol Ho, Adrian Brown, Catherine Corzo joining the C-suite and the board.
And key roles were expanded for people like Skowronski and Van Norden to manage R&D and business development.
Which raises the ultimate question.
What does the total lack of selling at these current all-time highs, 1060 plus, tell you? If they saw 640 as a massive undervaluation and they have held all the way through 1050, it suggests their multi-year thesis remains completely intact.
Are they still fundamentally undervalued compared to the coming tsunami of sustained global demand that their secure capacity and policy wins now guarantee?
The holding pattern confirms they view this as still early in the trajectory toward market dominance. Keep watching those Form 4s.
It seems the party has just begun.
Exactly.
Thank you for joining us on this research in detail. Make sure you are monitoring these C-suite cluster buys in other sectors because the LLY playbook proves the signal works. We'll be back next time to analyze where the smart money is moving now.